The lecture today will cover the second part of Chapter 2, pages 56 through 63 of the Understanding Financial Statements textbook. The rest of Chapter 2 will be covered in the PowerPoint lecture labeled Chapter 2, Part 3. The next current asset account we will learn about is inventory. Manufacturing, retail, and wholesale firms sell products to customers, and these products are referred to as inventories. Service firms sell services rather than inventory. Manufacturing firms carry three different categories of inventory: the raw materials, which will be used to make a product; the unfinished products, which have been started but not completed at the end of an accounting period, called work in process; and finished goods, which are the completed products. Retailer and wholesalers carry finished goods. Inventory accounting impacts both the balance sheet and the income statement. Products or goods which have not been sold are reported as a current asset on the balance sheet. Goods which have been sold are reported as an expense on the income statement, titled Cost of Goods Sold. Companies must disclose in the notes to the financial statements the cost flow assumption chosen to report the dollar amounts of inventories in the financial statements. An important point to remember is that the inventory cost flow assumption has absolutely nothing to do with the actual or real flow of goods. While there are many inventory methods, we will focus on the three most common methods used by firms: FIFO, LIFO, and average cost. FIFO stands for first in, first out. This means the cost flow assumption is that the first goods acquired are assumed to be the first goods sold. Therefore, the first purchases or goods manufactured will be reported as cost of goods sold, while the inventory account on the balance sheet will include the last purchases or goods manufactured. The last goods purchased are always the goods that represent an amount closest to the current cost of those products. LIFO stands for last in, first out. This means that it is assumed that the last goods acquired will be the first goods sold. Therefore, the last purchases or goods manufactured will be reported as cost of goods sold, while the inventory account on the balance sheet will include the first purchases or goods manufactured. Average cost is based on a weighted average, and from a dollar standpoint will always generate amounts for cost of goods sold and inventory that fall in between the FIFO and LIFO amounts. Let's go over an example of how to calculate the cost of goods sold and the inventory balance that will appear on the financial statements. Assume a company purchases 5 units of product at costs ranging from $5 to $11 per unit. The firm then sells 3 of the 5 units. This will leave 2 units in ending inventory on the balance sheet. Using FIFO, the cost of goods sold dollar amount will be the total of units number 1, number 2, and number 3, which cost $5, $7, and $8, for a total of $20. The ending inventory amount will be the cost of the last 2 units, which cost $9 and $11, for a total of $20. LIFO, on the other hand, assumes that the 3 units sold would be the last 3 units, which cost $11, $9, and $8, for a total of $28. The ending inventory of LIFO would consist of the first 2 units, which cost $5 and $7, for a total of $12. To calculate average cost, multiply each unit times the price paid per unit and add all of the totals together. In this case, since there was only 1 unit purchased each time, we can just add up 5 plus 7 plus 8 plus 9 plus 11, which equals a total of $40. The average cost per unit would be $40 divided by 5 units, or $8 per unit. Applying the $8 amount to the 3 units sold and the 2 units that were not sold, we can verify that the cost of goods sold should be $24, 3 units times $8 per unit, and the ending inventory should be 2 units times $8 per unit, or $16. Notice that no matter what inventory cost flow assumption is chosen, the cost of goods sold and the ending inventory amounts always add up to the amount paid for all inventory. In the case of Sage Inc., that would be $40. All methods would produce the same results if there was no inflation or deflation, but of course that is never the case. During a period of inflation, LIFO, which assumes the last goods purchased or sold first, will produce the highest cost of goods sold. An undervalued amount will occur for the inventory amount on the balance sheet, since the first purchases are assumed to still be in inventory and not sold. During a period of inflation, FIFO, which assumes the first goods purchased or sold first, will produce the lowest cost of goods sold, but the value for inventory on the balance sheet will be at current cost. The last account we will look at is an account titled Prepaid Expenses. This account means that the firm has paid for expenses in advance of being able to record them on the income statement as an expense. The second category of assets that most firms have on their balance sheet is fixed assets, more commonly referred to as property, plant, and equipment, or PP&E. Unlike current assets, PP&E lasts more than a year or operating cycle. PP&E is shown on the balance sheet at net book value, which means that the gross amount paid for these assets will be reduced by an amount of depreciation, or an estimate of how much the asset has been used up over an accounting period. Firms must disclose the details of the PP&E account either directly on the balance sheet or in the notes to the financial statements. Examples of items that show up in the PP&E category are land, buildings, leasehold improvements, construction in progress, and equipment. Depreciation will be recorded for plant and equipment, but not for property or land. Like the inventory area, there are multiple methods that can be used to estimate the amount of depreciation. If the asset will have a salvage or residual value when the firm is done using the asset, the amount of depreciation will equal the original cost minus the salvage or residual value. The two methods of depreciation that we will examine are the straight-line method and an accelerated method. Assume Sage has purchased an artificial ski mountain. The original cost is $50,000, and there is no expected value of this asset at the end of its 5-year life. To calculate straight-line depreciation, divide the original cost minus the residual value by the number of years in the life of the asset. The depreciation expense that would be recorded each year on the income statement is $10,000. An accelerated method is a mathematical process that causes the amount of depreciation to be much greater in the first years of the life of the asset compared to the later years. The example seen here is using a method referred to as double declining balance. In this case, we multiply the book value of the asset each year by a rate that is double the straight line rate. Using this method produces an amount of depreciation expense in year one of $20,000. Notice how this information would be shown on the income statement and the balance sheet depending on which method is chosen. While depreciation expense is smaller using straight-line depreciation, the book value of the assets, $40,000, is larger than what appears when using the accelerated method. By the end of the 5th year, both methods will have a total expense of $50,000 for depreciation, and the book value on the balance sheet would be 0 under both methods. This concludes the second part of the Chapter 2 lecture. In Part 3, we will look at the liabilities and equity section of the balance sheet.